The Federal Housing Administration, or the FHA, announced that it's increasing the maximum term for a mortgage modification to 40 years or 480 months. We all know that the previous term limit was 30 years or 360 months. And if you don't know what FHA is, Congress created it way back in 1934 during the Great Depression, and then it became a part of the U.S. Department of Housing and Urban Development in 1965. The FHA loans are insured by the Federal Housing Administration, and conventional mortgages or conventional loans are directly from the lender. But anyway, this video isn't about the differences between FHA and conventional loans. I want to go over the pros and cons of the 40-year fixed mortgage rate compared to the 30-year fixed mortgage. And I'm going to use the historical data in the state of Nevada as an example, since that's the state where I reside. But if you want to do research on your own, I encourage you to find out the historical home appreciation rates in your city, state, or town. But so first, I want you to take a look at the home appreciation rates in the state of Nevada, because it has everything to do with what I'm going to talk about with the 40-year mortgage. And since 2000, homes in Nevada appreciated almost 205% with a 5% average annual rate. This is also due to the housing crisis in 2008 and 2009 that contributed to the lower rate of 5% average annual rate. This is also due to the housing crisis in 2008 and 2009 that contributed to the lower rate of 5% average annual rate. However, in the last 10 years, homes in Nevada on average appreciated 11.66% annually since 2012. And I bought my house back in 2014, and I can tell you that my house has appreciated by 109% total, or 13.7% average annual rate, which is incredible, right? And between 2020 and 2022, home prices appreciated by 35%, and now we're seeing a significant decrease to about 10%, which is in the correction phase. And that's still a net increase of 25% or 12.5% average annual rate. Could we see a continuous decrease in the housing market? Quite possibly. The problem is the level of inventory in a city like Las Vegas, right? And I can't tell you how the housing market in your town or city is performing, but the performances are different city by city and state by state. And let me know in the comment section down below if you're paying attention to the housing market in your area. But anyway, even with a 6.5 or 7% average 30-year fixed mortgage rate for people with excellent credit scores, people are still buying houses. And this is evident in the consumer price index data that people are still spending money. And we still have a very low unemployment rate because there are more job vacancies than workers due to many people retiring early back in 2020 and 2021. The rental prices in some cities have come down, but some towns and cities are still increasing year over year. So again, it really depends on the inventory level and the demand in your area, right? But generally speaking, home prices in the US are still higher than the normal average rate since 2019. And I've had people tell me in the private group sessions that they overpaid for their homes in 2020 or 2021 by 20 or 30% because they were so blindsided by the lower interest rates. They ended up paying over 50% of their take-home income towards their mortgage payments, which hurt their savings rate in the short term. Luckily, they got to downsize their home last year, and now they're paying about 30% of their take-home income, which is a lot better than 50%, right? And if you're interested in joining my private Facebook group or becoming a member of my channel, because I have a public live stream and private group sessions every other Wednesday to talk about all kinds of financial independence investment and early retirement strategies, you can visit firesidechat.com/pricing or firesidechat.com/coaching to schedule your financial coaching session to discuss your financial journey. So let me show you the direct comparison between the 30-year fixed mortgage rate and the 40-year fixed mortgage rate. Now I'm gonna use the historical data of a 5% increase in home equity annually. The left side of the screen is the 30-year fixed mortgage rate of 6.9%, and the right side of the screen is the 40-year fixed mortgage rate of 7.2%. The longer the mortgage terms, the higher the interest rates it'll be, right? It's the same thing with the 15-year or 30-year. And I'm just estimating here with the 40-year mortgage because I don't have the actual 40-year mortgage rate, directly from the market. It's not official yet. And it could be even higher at 7.4 or 7.5%. But I'm just going to do 7.2% for this scenario. So let's say I buy a house for $400,000 with a 5% down payment of $20,000. The loan amount would be $380,000 with a 6.9% interest rate for 30 years. My P&I payments here would be $2,500, and that's not counting the homeowner's insurance or the property taxes, right? The total number of payments would be 360 times and almost $521,000 in total interest. If you take a look at the right side of this spreadsheet, I have the home value starting at the purchase price of $400,000 just to be conservative, because I put a 5% down payment and paid $317.68 in principal on my very first mortgage payment. I now have $20,317.68 in home equity. The home value is set to increase by 5% annually using this block of the spreadsheet. And you can adjust it to however many you want, like 6% or 7% annually. Does this make sense so far? If not, just rewind this video for a minute and watch it again. And before I get into the 40-year mortgage calculator, don't forget to download my financial independence resources, including all of these spreadsheets I'm about to show you, for absolutely free by visiting firesightchat.com/resources. You should also check out my Fireside Chat shop to check out the books and equipment I use for my YouTube studio at firesightchat.com/shopping. For the 40-year mortgage, I'm going to use the same exact scenario with $400,000 and a 5% down payment of $20,000. The loan amount would still be $380,000, but it's still with a 7.2% interest rate for 40 years. My P&I payments will be reduced by almost $100, but the total interest I would pay for the 40-year mortgage would be $780,000 for 480 months. And that's significantly more than the 30-year mortgage at $521,000. And that's about $260,000 more in interest for the 40-year mortgage. And I'm gonna look at the home value after 10 years of owning the home. And assuming that the value increases by 5% annually right here, so my hypothetical home would be worth $600,000 with an equity of $244,000. With a 30-year mortgage, I would have $275,000 in equity, or $30,000 more, because I'm paying more in principal with the 30-year term, right? So in 10 years, I'm paying down on average an extra $3,000 in principal every single year. That's just an average, okay? And what if I use the 10-year historical return with an 11% average annual return? And I would have $515,000 in home equity if I had a 30-year fixed mortgage, which is absolutely insane because the home value would be $840,000. And the 40-year mortgages, home equity would have $485,000, which is still a difference of $30,000. So this is actually very simple math between equity and your home value. Obviously, your home value could increase or decrease at any given year, right? And we could see a decrease of 10% this year, and then maybe a 5% increase next year. But historically speaking, the value of your home will go up over time. It's almost unrealistic to say that you're going to stay in the same home forever, because American people on average move 11 times in their lifetime. Now, I also read somewhere that the average term life of a mortgage is about 7 years. So that means people either refinance or move to a new home every 7 years. And another common misconception is that your house appreciates in value, but it's actually the land it sits on that appreciates in value. The physical structure of your home actually depreciates over time, like your roof, garden, windows, and garage. Natural disasters and climate change can also be a factor that lower your property value because of the risk of purchasing. And just for the sake of this discussion, what if you stayed in your forever home for the next 40 years? Your home in 40 years with a 5% increase in value every year would increase from $400,000 to $1.2 million. And if it's a 10% increase, then it's $2 million, right? In 30 years, it would be worth $1 million with the same 5% annual increase. So what are the pros and cons of the 40-year fixed mortgage? It's pretty obvious that now that I showed you the math a little bit ago, right? Your mortgage payment would be lower with a 40-year mortgage. As a matter of fact, if it's a 7.3% interest rate or 7.2% for the 40-year versus 6.9% interest for the 30-year, you would save around $100 a month in P&I. If I invest that $100 a month in an index fund with a 7% average annual return, in 40 years, it would be about $256,000. And if I saved $200 a month, that's $512,000 in 40 years. But is it worth it? Because the big downside of this is the interest payments. If I bought a house for $400,000 with a 40-year mortgage, that's a total of $780,000 in interest payments. So even if I saved $100 a month in P&I payments by investing the difference, that's still $260,000 more in interest than I would have to pay for the 30-year mortgage. With a 7% return for the next 40 years by investing the difference, theoretically, the total interest payments will still be more than what I would make by investing the difference. And the other flip side is that your home equity in a 40-year loan would build much slower than the 30-year mortgage. You saw the demonstration earlier about the difference of $30,000 in equity if you decide to sell the house sooner with a 5% annualized increase. Because with a 40-year mortgage, you're paying more interest for the first 30 years of the loan unless the loan is structured to have you make interest-only payments for the first 10 years. And I've said this over and over again on my channel that you should keep your mortgage payment under 25% of your income because your other 50% might need to go to your other expenses while you're investing the other 25%. If the 40-year mortgage makes a big difference for your budget, then make sure you have the plan to take advantage of it. But don't stay on it for the full 40 years if you have the ability to refinance it later on when the Federal Reserve cuts interest rates, right? And I would fully take advantage of it by going to the 30-year fixed mortgage rate with a lower interest rate. And I'm recording this video in April 2023 when the interest rates are at a 15-year high. Are they gonna stay high for a long time? I really doubt it. And I wouldn't be surprised if they start cutting interest rates as early as the fall of 2023. Now that the 40-year mortgage is becoming mainstream, you should make sure you have a solid budget plan before you buy your first home. How long do you plan to stay in the house you're purchasing? How much more interest rate will you be paying with a 40-year versus a 30-year mortgage? Use the spreadsheets I showed you earlier by going to firesightchat.com/resources. My plan with my 30-year fixed mortgage is to pay off my primary home by the time I retire early or when I turn 50 or 55 years old when I want to be more risk averse. Don't just do the 40-year mortgage because you want to lower your monthly payments. Do the 40-year mortgage because you have the plan to refinance later on or have the plan to build your wealth with the lower mortgage payments. Am I going to get the 40-year mortgage? Most likely not. But what do you think? Would you do the 40-year mortgage? And if you want to know more about how to decide when to pay off your mortgage and when to invest the difference, be sure to check out these two videos. So with that said, I appreciate you watching my video. Don't forget to subscribe and I hope to see you in the next video. Have a good one.